silver just crashed 42% from its all-time high. And a mining CEO, a man who digs the metal out of the ground for a living, just told us that $50 is perfectly fine. That is the most important thing you will hear today. Welcome back. This channel exists for one reason: to give you the data that institutional media either does not have time for or does not want you to see. If you are not subscribed, do it right now, because what I am about to walk you through is not speculation. It is mathematics, it is geology, and it is the most compelling structural case for silver that has been laid out in public this entire year. Let me set the scene for you. As of this morning, silver is trading at approximately $70.50 per ounce. Gold is sitting near $4,130 per ounce. That gives us a gold to silver ratio of roughly 59-1. Write that number down. We will come back to it. The nominal all-time high for silver was $121.67, set on January 29th of this year. We are now 42% below that level. 42%. And the crowd that has been watching mainstream financial media is being told this is a bubble collapsing. Here is what they are not being told. Let me show you. There are two forces operating in silver right now, and they are moving in completely opposite directions. The paper price, the number you see on your screen, the COMEX futures number, is falling hard. It fell over 10% in a single week in mid-March, driven by a hawkish Federal Reserve hold at 3.5 to 3.75%, by oscillating oil prices from an escalating Middle East conflict, and by leveraged momentum players who ran into this trade fast and are now running out of it just as fast. That is the paper market. That is the machine. That is noise. Now here is the other force. The physical market, the actual metal, the stuff you can hold in your hand, is telling a completely different story. And this week on camera, a man who has been digging silver out of the Canadian Shield for his entire career said something so important that most viewers watching the original interview probably missed it. He said, "Nothing is wrong with a $50 silver price. Miners can make good money at that rate." Think about what that means. A mining CEO, not a YouTube commentator, not a newsletter writer, but a man responsible for developing a high-grade silver project in Ontario with drill intercepts that compare globally. He is telling you $50 is a solid floor, and yet this same metal traded above $100 just weeks ago and is now available for $70. The math is sitting right in front of you. Let me give you the structural case now, because this is where the data takes over from the emotion. The global silver market has been in a supply deficit for 6 consecutive years. That is not a prediction. That is confirmed data from the Silver Institute, the industry's most credible tracking body. In 2025, global silver demand reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, came to roughly 1.01 billion ounces. That is a deficit of over 230 million ounces in a single year. To put that in perspective, 230 million ounces is the equivalent of Mexico's entire annual silver output, and Mexico is the world's largest silver producing nation. Gone every year, drawn down from inventories that are already being depleted. Since 2021, the cumulative shortfall is now approximately 820 million ounces. That is nearly a full year of global mine production that has been consumed and not replaced. It has gone into solar panels, it has gone into electric vehicles, it has gone into the servers and semiconductors powering the artificial intelligence build-out. It is not coming back. Silver that enters an industrial application is in most cases gone forever. Now here is what makes this week's correction so paradoxical and so important. COMEX registered inventory, the silver that is actually available for physical delivery on the exchange, was sitting at approximately 113 million ounces. Entering this correction, the March 2026 futures contract alone represented 528 million ounces of paper exposure. Let me say that again so it sinks in. 528 million ounces of paper promises, backed by 113 million ounces of deliverable metal. That is a leverage ratio of more than 4 to 1 on a single contract month, and yet the paper price is falling. If you are confused about how a market in structural deficit with 4 times leverage paper exposure on a single futures month can see its price fall, congratulations, you are asking the right question. The answer is the same as it has always been. The paper price and the physical price are not the same thing. The paper price is a negotiated fiction. The physical price is reality. And right now, the fiction is cheaper than the reality. That is a buying signal, not a selling signal. Every reference I have cited is in the description below. Subscribe right now if you have not already, because what comes next is where this story gets significant. The demand side of the silver equation is not static. It is accelerating. Right now, the well-understood industrial drivers, solar photovoltaics, consuming between 200 and 250 million ounces annually, electric vehicles consuming another 40 to 60 million ounces, those are just the baseline. What is sitting on the horizon is something the market has not fully priced. Stanford researchers publishing in January 2026 in the journal Nature Materials confirmed something that Samsung has been quietly developing for years. A nanoscale silver coating just 3 nanometers thick solves the cracking problem that has plagued solid-state battery technology. Silver-treated solid electrolyte surfaces become 5 times more resistant to lithium intrusion damage. The implications are extraordinary. Samsung's silver carbon composite anode design for solid-state batteries is estimated to require approximately 1 kilogram of silver per 100 kilowatt-hour battery pack. Compare that to the 25 to 50 grams current lithium-ion vehicles use. BMW is reportedly partnering with Samsung for evaluation vehicles later this year. Toyota has solid-state production targets of 2027 to 2028. Think about this for a moment. If solid-state battery adoption reaches even 20% of the electric vehicle market by 2030, not 50%, not 100%, just 20%, analysts estimate that adds 514 million ounces of new annual silver demand. That is roughly equal to the entire current annual industrial consumption of silver, layered on top of a market that is already running 600 million ounces per year below sustainable supply levels. And yet the paper price this morning is $70. Drop a comment below and tell me this. Do you think silver retests $100 before the end of 2026? I want to know what you think. The data is laid out in front of you. Make your case. Now let me bring this back to the mining story, because this is where the investment thesis gets grounded in something verifiable. Gary Thompson, chairman and CEO of Brixton Metals, is currently drilling a project called Langus in Ontario, a past-producing high-grade silver mine that produced 10.5 million ounces of silver historically at a head grade of 25 ounces per ton. His team has been generating drill results that, when normalized by grade multiplied by intercept width, what geologists call gram meters, sit among the globally significant silver discoveries currently being developed. He said something this week that deserves to be repeated. He said the fundamentals that drove metals prices higher are still intact, still in place. A price correction in paper does not correct geology. Here is what else Thompson said that the mainstream coverage will miss. He said companies developing mines are still using conservative pricing models because the price moved too quickly to recalibrate. Feasibility studies are built on assumptions far below where silver traded at its peak. What that means in practice is this. If silver simply holds current levels, which even at $70 represents a 130% increase from where it was 18 months ago, the economics of silver development projects are transforming faster than the industry can model them. Projects that were marginal at $30 are exceptional at $70. The street has not reprinted its valuations yet. He also made a point about jurisdictional risk that the smart money understands and the retail crowd largely ignores. Ontario, where Langus is located, has stable rule of law, flow-through tax credits that effectively subsidize exploration capital, and a permitting environment that is actively supportive of mining development. When you are allocating capital in a resource sector experiencing a multi-year structural bull market, jurisdiction matters as much as grade. A world-class deposit in an unstable country is not an asset. A solid deposit in Ontario, Canada, with BHP as a strategic investor in your copper project and a maiden resource target for high-grade silver is a different conversation. Like this video right now. If you have learned something that changes how you see what is happening in silver this week, it helps more investors find this analysis, and that is exactly the goal here. Let me now deliver the conclusion that ties this entire video together. Two things can be true simultaneously, and both are true right now. 1. The paper price of silver has corrected sharply, and some of that correction reflects legitimate speculative excess being flushed from a market that ran too far, too fast, in too short a time. SP Angel Metals analyst Arthur Parrish put it clearly. The tourists who arrived during the momentum leg are now leaving, and that is exactly what needs to happen before the next structural advance. 2. The structural case for silver. The deficit, the demand growth, the COMEX inventory drain, the Samsung battery catalyst, the 6-year supply shortfall, the paper to physical leverage ratio, none of that has changed by a single ounce. Based on the historical pattern of how commodity markets behave when paper leverage meets physical scarcity, my analysis suggests the next move in silver will be driven not by retail momentum, but by industrial necessity. When battery manufacturers, solar panel fabricators, and semiconductor companies cannot source physical metal at any price, the paper price becomes irrelevant. The physical price takes over. And at that point, $70 will look like the floor that the CEO already told you it was. This is not financial advice. Every individual has their own risk tolerance, circumstances, and objectives. And this analysis is purely educational. Every reference is in the description below. Now share this video with someone who is watching the price and getting confused by the noise. They need to see the signal. There are 3 types of people watching this right now. The first type sees silver down 42% from its high, and they are panicking. The second type knows silver has strong fundamentals, but does not know what to do with this week's data. The third type understands that a paper market flush in the middle of a 6-year structural deficit with 4 times leveraged futures exposure and a Samsung battery catalyst that the market has not priced. That third type is not panicking. They are positioned. Which type are you? Drop your answer in the comments below. Subscribe, hit the bell, and I will see you in the next one.